Hey traders, welcome back to the channel. Today we're diving deep into one of the most misunderstood tools in trading, the RSI, the Relative Strength Index. It looks simple, right? A number from 0 to 100, telling you when an asset is overbought or oversold. But here's the truth: if you're relying on RSI alone to place trades, especially as a beginner, you're probably using it wrong. And I'm going to show you exactly why. Let's start with the most common mistake new traders make. They treat RSI like a buy-sell button. RSI hits 70? It's overbought, I'm selling. RSI hits 30? It's oversold, I'm buying. But this logic is flawed. In fact, some of the strongest market rallies happen when RSI is above 70 and continues rising. And some of the most brutal sell-offs happen even when RSI is already below 30. Here's what RSI really measures: momentum. It's not just how far the price moved, it's about how strong that move is. So when the RSI is high, it's telling you that the bulls are in control. When RSI is low, bears are dominating. But momentum doesn't reverse just because a number says 70. You need to look at context. Is the market trending? Or is it moving sideways? So here's how to actually use RSI like a pro. Step 1. Identify the market condition. If the market is moving between two clear horizontal levels, then RSI extremes, above 70 below 30, can give you decent reversal signals. Here we have the euro to US dollar chart, which is moving within a ranging zone and consolidating inside a box. Whenever the RSI goes above 70, we take a sell position, and whenever it drops below 30, we open a buy position. As you can see, this setup has provided several accurate signals that could have resulted in solid profits from the market. But if the market is trending, forget those levels. In trends, RSI will stay extended. Instead, look for RSI divergences. For example, price makes a higher high, but RSI makes a lower high. That's a warning. It means momentum is weakening even if price is still rising. RSI gets even more powerful when combined with other tools. Support and resistance levels, trend lines, Fibonacci retracements, they all work great with RSI. For example, if RSI shows bearish divergence right at a key resistance level, that's a higher probability setup. It's not about using one tool. It's about confluence, multiple signals pointing the same way. That's how pro traders think. So next time you pull up your chart and look at RSI, don't rush into trades. Ask yourself, what's the trend? Is RSI supporting the trend or showing divergence? Are there other signals lining up with RSI? Use it with logic, use it with patience, and most importantly, never rely on just one tool. If this video helped you, drop a like, subscribe, and let me know in the comments. What indicator should we break down next? Trade smart, I'll see you in the next one.